Welcome to Galaxy Brains.
An infinite amount of cash.
I'm your host, Alex Thorn.
The U.S. banking system is sound and resilient.
Bitcoin made a new all-time high.
If you're not long, you're short.
Satoshi's going to come on there, laugh hysterically, go quiet, all Bitcoin's going to be erased.
Bitcoin's the best crypto out there.
Bitcoin is going to zero.
Welcome back to Galaxy Brains. As always, I'm your host, Alex Thorn, head of firm-wide research at Galaxy. Bitcoin not zero. And we have a great episode for you today. Anton Katz, co-founder and CEO of Talos, is our guest. We're going to talk with Anton about institutional crypto trading technology, what he's seeing on the adoption front, and what the future of crypto trading and tokenization might look like. We're also going to check with our friend Connor Finemore from Galaxy Trading. BIMnet is out this week. We're going to introduce you to Connor, and Connor's going to talk to us about the current macro environment, how markets are reacting to various administration items, and how they're talking about tariffs. We'll also talk about Connor's view of who has been buying and selling the equity markets over the last month or two. It's quite interesting, and of course, the impact on Bitcoin and crypto markets. Before I get to that, I need to remind you to please refer to the link to the disclaimer in the podcast notes, and note that none of the information in this podcast constitutes investment advice or an offer, recommendation, or solicitation by Galaxy or any of its affiliates to buy or sell any securities. Let's hop right into it with Connor Finemore. Let's go now to our guest, Connor Finemore from Galaxy Trading. Connor, welcome to Galaxy Brains.
After all of these years, I finally get the look. I'm excited.
So BIMnet is ill this week, and Connor works with BIMnet on the trading team. And I asked, and Connor's an astute observer of markets, so I asked Connor to come and give us the lay of the land. Connor, we are in this period of uncertainty that followed the market euphoria of January. We've sort of been down to sideways and uncertain since then. A little bit of a rally this week in equities and in Bitcoin. What do you make of that rally, and what are you seeing out there?
Yeah, I mean, I think the period has still been very volatile. And when you start to drill down into the different investor classes and how they've been trading this move over the last month, we've observed that long onlys really have been big net sellers. And that's been, week after week. And those guys don't really pile back into markets when equities start moving higher. And so this rally's been really lightly participated. Volumes are running 30% of the 20-day average. And so, we still think that this is a headline-driven market. And anything that Trump says, 100 keystrokes, can change the direction.
And there was an interview he did on Sunday where he seemed to narrow the impact of tariffs that are these reciprocal tariffs that are going to come up on April 2nd. He seemed to say they might be more targeted than the market thinks. And that was that the fuel for this?
And I think that's just sort of the ebb and flow that we've had. Tariffs on, tariffs off. How big is it? What are the actual impacts? I remember when the China tariffs initially happened, it was a 10% additional tariff, and everyone's in the market going 10% on top of 10%, 10% total, is that 20 plus 10? Like, the communication has been vague, and so that's left markets really scrambling and really guessing, and a lot of the times, it, even within the administration, it's not clear that everyone's aligned on exactly what the plan is, and so all it really takes is one headline today, which we sort of saw, to turn equities right back around, and so, volatility is low. We think that owning vol, however you express it, continues to be a decent trade, and try not to get too committed to your views because things are changing really fast.
There was a great interview on the All In podcast, which I'm generally not a huge fan of, but with both Treasury Secretary Scott Bessent did an interview last week. So did Commerce Secretary Howard Lutnick. Did you listen to those interviews?
They're both required listening. Yeah. I think, particularly Bessent.
Yeah. What was your takeaway on Bessent? I mean, they may have made many, but
there are many. They're really focused on the 10-year. I'm sure that's been a conversation topic. I'm definitely not reinventing the wheel with that, but there's a lot of focus on tax receipts and tax policy. We're getting into that time of the year. There's been some conversation that receipts are lower, and that really puts even more pressure on the fiscal situation. Right? They want to cut spending. They want to cut taxes. But if they're not taking in enough receipts in a year where stocks are up, wages are up, unemployment's low, everyone's had a really good year in 24. With this more complicated backdrop in 25, it's setting up a really hard job for Besant.
Yeah, I thought he was also extremely thoughtful and intelligent about, which I guess shouldn't be a surprise given that he's a longtime investor.
Definitely.
This is a tricky needle that they appear to want to thread, right? They want the 10-year and rates in general lower. It's better for the debt for sure. It's also better for homeowners and home buyers. But they want to cut all this spending. But that can also harm the economy, right? If they, lay off.
Yeah, I mean 100%.
What is it? 4 million people work for the federal government?
Yes, I don't know the exact
crazy,
number.
Many millions.
It's something like that, and you cut 10% of that, and they're not exactly low earners either, and they live in population centers in the country. So that impact, we haven't observed a ton of it in the data yet. It exists in certain pockets, but it doesn't take a lot to see. They're cutting people at the SEC. They're cutting people at the IRS. They're cutting people, DOE, all of that type of stuff. So I shouldn't say DOE. It's Department of Education. I mean, not Department of Energy.
Right. Well, maybe. But yes.
We'll
education
see.
They've talked about.
Definitely.
Yeah.
So yeah, I think that sort of stuff is going to take time to play out. But it definitely makes it hard to be very, very constructive, particularly risk markets, and that bleeds over to Bitcoin, right? Because at least for now, it really feels like Mike had this great comment this morning. He called it the Mag 8 and included Bitcoin with them, and the reality seems to be that's really how we're trading.
Yeah, it's trading like a big macro equity, basically, like a NASDAQ.
Right, which provides an interesting opportunity to hedge yourself. If you want to sit with your core Bitcoin positions, equity vol has come in a lot in the last couple of days. S&P downside might be an interesting way to hedge yourself so that you can sit with your core longs and try and weather the storm.
Yeah, that is interesting. I wanted to ask you about the strategic Bitcoin reserve. I know you're a skeptic, so I'd love to, if you make, what is the skepticism? I don't get me wrong. I don't think this is that hard a question.
No, it's not. I mean, it's a funding question. It's a focus question. I think the more that the Bitcoin as digital gold becomes sort of consensus in the American psyche, then maybe it makes more sense. And I always laugh at the budget neutral conversation because in my view, there's no such thing as budget neutral, right? Everything that the government does has to be funded by something. And so, whether it's selling $2 billion of gold a month to buy Bitcoin or something like that, that'll create shockwaves, or privatizing Fannie and Freddie and using some of that funding to buy Bitcoin or other strategic assets for the U.S. I mean, there are a lot of different ways that they can do it, but I just think that right now, it's early and it's going to require a lot of political needling.
Yeah, any dollar you spend on Bitcoin is theoretically a dollar that could be spent on something else, let alone just saved to close the fiscal gap, right?
Yeah, right. Like you could pay like 200,000 employees or something, for example.
It is a super interesting, not just that, but things like tax cuts or, they talk no tax on tips would be a net new tax cut. They're talking about, I think Howard Lutnick mentioned, no income tax for those who earn less than $150K a year.
Right, which is an interesting one because functionally that's kind of how things
I was going to say something like
but
75% of all taxes are paid by people that make more than $150K per year.
Right.
But like when you talk about these are offsets, right?
Mm-hmm.
So like you want to simultaneously close the gap in the deficit while also taking money and putting it into Bitcoin. Introducing new tax cuts, right? Like,
right.
It's hard to sort of square that circle yet. I know it's still early. I'll give them a little bit of credit here that we're not really
100%.
sure. But I look at that with, I think maybe this contributes to the uncertainty that we're seeing.
Definitely. And I think you've got to find funding sources at some stage, right? And that's always the hard conversation. Like when you're cutting spending, like someone is going to lose. It's the way it is. If you're going to raise tax receipts from somewhere else, university endowments seem to be very in the focus right now. Maybe Harvard shouldn't have a $50 billion endowment, but then people will say, well, what about research? What about financial aid? There's always a push and pull, right? And then there's a conversation in the ETF world right now, like how many tax receipts has the U.S. given up from, the $1 trillion of assets that's moved from mutual funds to ETFs? I know that's not really a core conversation for this podcast, but, those capital gains have been great in the U.S. Maybe some of the winners should be paying some of that to the society that created all of this wealth, right? That's a totally different conversation, but probably to the tune of hundreds of billions of dollars in missed taxes. So
yeah, it's fascinating.
Very.
before we wrap, Connor, I wanted to ask you, you're more of an equities and traditional markets guy.
Sure.
What are you doing working at Galaxy? What gets you excited about being in the crypto capital markets?
It's the people that I meet, and I have to be careful that I don't mention any specific things that I'm working on, but you'll be surprised the amount of people that are engaged with the space that are either dipping their toes in or have been involved for a while that need new styles of financing to work on their real businesses. This is totally separate from token projects, right? And it's been a very fun way for me to engage in the space, work with companies. How do I do a bridge financing for you while you work on another capital raise? How do I help you manage your treasury if you want to use Bitcoin as a treasury asset? These sorts of things have been really where I've been able to carve my space at Galaxy, and just the people that you come across, it's really a really incredible subset of the world. So.
I totally agree. Well, I appreciate you coming on Galaxy Brains, Connor Finemore from Galaxy Trading. Thanks so much.
Thanks for having me. Hopefully it's not the last time.
No, it won't be. Let's go now to our guest, Anton Katz, CEO and co-founder of Talos. Anton, welcome to Galaxy Brains.
Thank you very much for having me. I'm a big fan of the show.
I appreciate it. I'm a big fan of you. We've known each other. It's 2025. We've known each other for 7 years.
That's right. It's been 7 years since you and I met.
It's crazy. We were just talking about how we met
You look
at that
exactly
awful.
the same.
Well, that's is that good? I guess if I'm 7 years older, that's positive.
In crypto, that's tremendous.
I know.
That's a huge compliment.
I've got the grays now, which is relatively
barely,
recent, to be
sure.
honest. We met at that horrible W Hotel that's in Midtown, like near Times Square, and it's only like particularly horrible because like the lobby is like club music and like flashing lights. Do you remember that?
Yeah, it was right outside of some conference, and this is as we were just starting Talos and we were raising our first round. It was a pre-seed round, and you just started too.
Yeah, we had just started doing venture. It was probably Consensus, I'm assuming, like when it was still in New York. Well, tell us about Talos, what it is, and who you are, just as a starting point for the conversation.
Sound good. So Talos provides technology to institutions. And basically, our purpose is to be a one-stop shop for institutional traders to interact with digital assets. And we focus on crypto especially. So over the years, Talos have expanded its services pretty dramatically. But when we started, the thesis was very simple. We saw a niche in institutional trading, and that's kind of like where all of us at Talos come from. We come from capital markets, building trading systems. So our goal was to make sure that institutions, as they're getting into crypto, have an infrastructure that they can use to trade digital assets in the same way they trade in capital markets, right? So that meant all the different institutional tools. So in essence, initially what that meant for us is we connect institutions, so we have connectivity to all these different exchanges, OTC providers, and we do algorithmic execution, smart order routing, provide these kind of smarter tools for institutional investors to interact. Today, we cover a very wide gamut of clients. We have buy-side clients, we have sell-side clients, so we have a white label platform that allows folks to people like retail brokers and institutional brokers to provide their clients with the ability to trade crypto. But we also provide services around portfolio management, portfolio construction, which is more geared towards asset managers. We have reconciliation, clearing, settlement. So more and more today, Talos is really providing this one-stop shop really across the entire investment lifecycle, from all the way from pre-trade to post-trade. And so we are kind of like the gateway for a lot of the institutions, whether they're small or large, to enter and interact with crypto.
So do you build all of the tools, or is part of it the connectivity into tools that maybe they already have, like whether it's order entry, or like if I'm thinking about working at Fidelity where I was, like, they've got OMSs and like some people like to trade in Bloomberg. Like, is it both, or do you have your own front ends? And
That's an excellent question. So generally speaking, it really depends on the client. But you have to be prepared for the fact that you might do some custom integrations and you might integrate with existing functionality. So you're right. When you're talking about somebody like Fidelity, right, and generally larger institutions, in many cases, they will have their own tool set. They will have tools that are, maybe on the pre-trade or on the post-trade, they're using in other asset classes. Maybe they're looking at risk across the board, right? These kind of institutions, they can't treat crypto as a standalone, and I think that's going to be also part of the trend in the market, where we're going to see people are not thinking about like crypto as this bastard child, but rather cryptocurrencies are likely going to be an asset class, and you're going to be treating it as one of the asset classes that you're interacting with. So some of the capabilities that we have on our side and some of the integrations are with these more legacy systems, more internal tools. And we also do servicing. Like we go to the client and we integrate with their internal systems. So that happens. But That's one side of the clients, right? That's kind of like the more established multi-asset institutions. We also have clients that are crypto natives, started their operation in crypto, they're lean, they're fast, they're able to run, and they do everything inside Talos.
Yeah.
And there, we don't need a lot of integration because whether it's from an API perspective or UI perspective, they just go to Talos and they get all their tools there.
Got it. So you have it like you said, the one-stop shop built in the product, but also you can integrate, which makes a lot of sense. Are you seeing, let's stick with the first wing that you talked about, the existing multi-asset, whether it's an asset manager like a Fidelity or a brokerage firm like a Fidelity, or even a big crypto shop for that matter that has built a lot but needs more. Like, are the traditionals really coming in? Like I saw, like, it was the CEO of Charles Schwab was like, had this interview like maybe 3 or 4 months ago or something, right? Where he said, yeah, like crypto, like we totally missed that, but we're going to do it now. And he was like, equities, we didn't miss that. And they were like, okay, it was like on CNBC or something, I forget. Like, well, if someone like a Schwab or anyone like that, a big legacy brokerage firm, right, that has a bunch of clients, maybe their own wealth management platform also wants to offer either those clients or have their advisors be able to put people into crypto, are they coming? Have you seen an uptick in demand for this? Because it sounds like the exact type of thing they would need.
Yeah, I mean, unequivocally the answer is yes, but with, you kind of have to put a disclaimer there. So 3 years ago, I was asked that question, and it's like on record, where I was like, institutions are coming and they're here and this is happening. And the reality was like, yes, there was quite a lot of institutions that were thinking about what to do in crypto, and based on client demand, they really wanted to add crypto capabilities to their, and provide those to their customers, so wanted to add it to the tool set. But there was not really true adoption. We've seen a couple of green shoots, but we haven't seen tons of traction. And the reality was that the minute there was a pullback on the market, we've had FTX, we had a couple of other events that happened. A lot of those institutions basically took a backseat and said, like, okay, we were just experimenting. This is not right now. I do think that has changed pretty dramatically. And it started with the approval of the ETF last January. And since then, I think we've seen a pretty steady state of institutions coming in and starting to work on it. And, the way they're coming into the asset class right now is very, very different than before. They're not looking to come in and do something big immediately. They're really trying to figure out like how to build, scalable, correct infrastructure. Compliance is in the room for a lot of these conversations. Security is in the room. So the entire envelope of supporting services is now coming into play, right? Mm-hmm. And as a result, it's taking a lot more time than some people think. Institutions don't generally move on the dime, right? So you will see institutions coming in now. On our side, what do we see? Sure. We forever had a lot of conversations. Like, we are the largest one in what we do. We're audited by one of the big four. We have all kinds of certifications. We do this around the world. So obviously, for a lot of the institutions, we are the first phone call. We have those conversations. That's always been great, right? But when those things actually convert, and that's different from one type of institution to another. If we're talking about banks, a lot of conversations, and I think that banks are really ramping up to it, but really I do think that it's like a 12 months to 18 months on average path for them.
Yeah, even from now.
From
when they start really trying to ramp.
Honestly, kind of like almost like from now.
Yeah.
Maybe say from the beginning of the year. But on the asset so look at the numbers on our side, right? Like in the past 6 months, we've added asset managers that are responsible for roughly, I think it's like $14 to $15 trillion.
Wow.
Right? That's real numbers. That's real large institutions that are coming into the space. You've seen this all across the news. They're speaking a lot more favorably. There's no reputational risk anymore. They are openly speaking about an asset class. So definitely very, very different now. We're also seeing the same on the retail brokerage side. We power quite a lot of these kind of capabilities, both for new retail brokers that are emerging and they're crypto retail brokers, but also in some of the retail brokers that are providing their customers access in other asset class and now starting to add crypto.
Yeah.
So 100%, but at the same time, like, I want to be cautious and say it's definitely the beginning of that path. We're seeing it's super positive and we're very, very bullish on that, but it's not from today to tomorrow. These things take time to build.
Yeah, that makes sense. I think the banks in particular had a lot of regulatory barriers, right? Whether it was SAB 121, which I know our mutual friend Matt Walsh, shout out Matt, you're the king of SAB 21 influencing.
So true.
I also am a big nerd on SAB 121 also, but that prevented banks sort of operationally from doing it because it made it too costly to touch crypto. But you had the OCC that had rescinded the Brian Brooks era guidance that would let national banks and trusts do crypto stuff. They've now just, I think last week, rescinded the rescission, so they're back. But the Fed had also stood in the way a bit, and Goldman's a bank holding company, so they're primarily regulated by the Fed. So like that's and there are others.
It's actually like you might also think about it as like this is the change that you were hoping for, right? It's starting at the White House level, then to the Senate, to the Congress, then goes to the CFTC and the SEC, and we're seeing quite a lot of change there, and move towards proper regulatory framework. Again, like you had Hester Pierce on the podcast, which is like really fascinating podcast to listen to. She is striking the right balance. She's not saying come what may. She's saying, let's protect it clearly. Like, we want to provide the guardrails. We want to provide and protect the consumers 100%, but we also want to provide the path of how to properly register, properly provide the services. So all the way through the federal level now, that change is trickling in. I think that the next level is going to be on the state.
Yeah, I think that's right. I think, and you've seen some at the state level as well. And just shout out also to Commissioner Peirce. How lucky this industry is to have such an intellectual giant basically leading the crypto task force at the SEC. She's had great ideas. And she said, yes, we do not tolerate liars, scammers, and frauds. That's not what this is about.
Yeah, that's exactly right.
We wanted them to go after all the. I mean, let's be real. There's plenty of scams and fraudsters in crypto. Like, we want those people to get got. Like, we don't want you. We wish that Chair Gensler had caught Sam Bankman-Fried and didn't sue Coinbase, which was trying really hard to do the right thing for the most part. Right.
That's right.
It feels like we're getting something much better. So I agree. The banks is such an interesting question. Like the big banks. Take a Fidelity, not a bank. They've been moving on this for years, and they did. They added retail Bitcoin and ETH trading like 2 or 3 years ago to Fidelity.com. But not a bank, not nearly the same. Certainly a FINRA broker-dealer and an RIA and like all these other things that are highly regulated, but they're able to do it separately next to their other stuff without having to fuss too bad. But a bank is very different. How close do you think they are? I mean, really, you said 12 to 18 months. Like, what more is left for them to? Is it just like it takes a long? Once they get the regulatory green light, there's, like you said, compliance, security, tech. Like, do we think that they're going to be big powers, the big iBanks, giant powers in crypto trading?
I mean, I do think that the banks are waiting for, not necessarily waiting, but there are at least a couple of other pieces that need to happen. Look, I mean, the first thing the banks look at whenever we have a conversation, they're basically saying, okay, so now we're saying, yes, this is happening. What do we need to do? What do we need to put in place, right? You do need to put all those pieces in place. You need to put custody in place. You need to put compliance pieces in place. You need to understand like what regulatory framework you're operating in, and you have to have an okay with the regulator. Because again, like the regulator, when they talk to a bank, they don't talk to them about digital assets or crypto. They talk to them about the collection of assets and collection of services they provide. So they need to be very, very mindful of what that conversation looks like and how that conversation evolves with the regulator. But generally speaking, it's process. It takes a lot of time in banks to actually get to the next level and then to the next level from there. Right. And we've seen, like we've worked prior to Talos, Ethan, who's my co-founder and CTO, and I worked at a very, very large provider. We were early employees there and grew that. And we were one of the largest provider of trading technology to the sell-side sector. Literally, banks were the clients.
Got it.
And I can tell you that even then,
like equities and FX tech and stuff.
Every single asset
Not
class.
a nascent asset class, though.
Nothing new about it, right? Like, we were coming in. It would take our sell cycle was 12 to 18 months.
Just getting them to sign the dotted line.
And this is an asset
for the ones
classes
that
they
too.
were very comfortable in.
Right.
And knew everything that needs to happen. So it's just people need to understand, like, when you're talking about retail, it's very easy for you and I to say, oh, I'm going to try this thing. I'm going to go on this platform. I'm going to send them $100. I'm going to trade, and I'm going to give it a go. I want to trade staking. I can do that. I want to do loan. I can do that. Right? That's not the same for institutions. That's part of the reason why process takes so long. That's part of the reason why they also need institutional tools, because the requirements are completely different, processes different. So it's a little bit of it is just patience, but at the same time, look, I mean, they're also not one and the same. Some are going to be a little bit more conservative, but we are seeing some banks that are, we're likely going to see some announcements within the next 3-4 months of really major progress on some of the banks. So, and that pushes the entire industry forward.
Yeah, I think so. And it's kind of inevitable too. Bitcoiners have wondered about this question. I was even asked for the ETFs. Is it good that so much Bitcoin is now held by BlackRock or Fidelity or Invesco? Is that good? Does it somehow, do they control Bitcoin now? Or the same question could be asked for, the big banks. Is that good for Bitcoin? Do you think it is or not, or does it matter, or is it good? I don't know. How would you think about that? And what I mean by
It's
good,
tremendous.
yeah, I was going to say what I mean by good is like, is it in keeping though with the cypherpunk ethos of Bitcoin, or is it not, or does it not matter?
Yeah.
And you said it's tremendous. I want you to.
There's a lot of interesting pieces here.
Yeah, there are.
So first of all, I would point you to the institutional investor research that was just released, where they, everybody that was surveyed by them, from everyone that was surveyed, 3/4 at this point are engaged with digital assets. 3/4, man. And it's 3/4 now. In what capacity? Well, I mean, the portfolio diversification is just that. You have to size your risk correctly. But 3/4 are engaged. And a huge amount of that engagement is because of the ETF. And people say that the ETF is going to kill Bitcoin and kill the ethos. I generally don't subscribe to very radical point of views. Like the maximalistic views where it has to be this way, it has to be this way. I don't think that's the right way. Bitcoin is a tremendous asset, and the underlying technology, blockchain, is a phenomenal piece of technology. My view and the view of Talos is that ultimately all assets are digital assets. And it's because as technologists, we look at it and the kind of capabilities that we get from blockchain are the kind of capabilities we could dream of in capital markets. If you're asking about banks, is it a good thing that banks are participating? 100% yes. It matures the entire asset class. It provides impedance to the prices. It allows you to actually start getting into use cases that were not available before. And I think the more adoption we'll see by the banks, the more maturity we will see across digital assets, and that's going to make it a lot more stronger.
That's a good answer. I agree with that. I also think, in particular, one thing that's interesting about Bitcoin, because it's proof of work, owning the asset doesn't give you any particular control over the network. There is, arguments to be made that economic nodes can have some sway. For sure they do. But do you think the same is true for a proof of stake asset? Like if we have, 2/3 of Ethereum sitting in a qualified, State Street or Bank of New York Mellon vault or whomever, and then there are governance questions. Does that impact, you think, for stakeable assets? Like the governance of the network, it's sort of capital controls consensus in proof of stake.
Yeah, it's a very, very reasonable question to ask, and I think that that's part of disclosure, that's part of regulation, that's part of what we actually need to make sure that we're governing correctly there. But I don't see it as a threat. Again, I'm coming from a mindset that this is likely a good actor behavior. And as long as we make sure that the good actors are at the table and they are governed and audited correctly, and we are aligned in terms of what they're trying to do for the industry, I don't see a huge issue there. But it is one of those things. Look, I mean, there's quite a lot of different things. I actually think that this is not even the hardest problem. The hardest problems are, it's a brand new technology evolving before your eyes. Again, I'm an engineer. I look at this and I have to tell you, I am 100% bullish on digital assets and I'm 100% bullish on crypto. But it is risky when I think about how quickly the evolution is happening on the technology side. Smart contracts that are potentially not necessarily audited or might include issues. We're talking about an asset that can move across continents in a flip of a switch, right? This is 10 minutes and it's somewhere else potentially. So I think that there's bigger risks, but I do agree with you. I think that thinking about the governance, thinking about what is the impact of this kind of assets and staking those assets.
Well, because it is going to change, right? I mean, this is a new paradigm of a new type of asset owner, new types of market infrastructure, new scale of market infrastructure. So whatever it is going to, at least superficially, going to look quite different than it did, when you were just trading in the troll box on Poloniex 10 years ago, right? So that I think it's a reasonable thing for people to wonder. I agree. I don't think it's inherently a risk to the underlying networks in any material way, but it could be. It's an interesting thing to watch.
It's growing pains.
Yeah.
You have to go through this. The good thing is that there's technology embedded in this asset class. And the minute that's the case, you can iterate on it. You can change things. You can deploy things that might make a difference, right? This is almost like a free market technology. If we feel that something is not working, you can change it. And if you feel that particular protocol is not working, you can move to another protocol.
Yeah, or propose upgrades to that protocol that
That's
fix it.
exactly right.
Yeah.
And the proposals are actually, again, not a super central, one person that says yes or no, could be potentially governed by a community.
Yeah.
And so this is the beauty of open source. You're getting into a domain where a lot of the common problems that you would see on in capital markets or in any kind of older systems don't exist here because of that.
Yeah, it's super interesting. Okay, I want to pull a thread that you mentioned, which was all digital assets. All assets are digital. Are you talking about tokenized assets? You think?
Yeah.
Or are we going to see? I have this thesis that I've shared a lot with our audience about. For example, DeFi apps really good, but the assets on chain are pretty bad and need to be improved, right? I mean, in the scheme of things, you've got Bitcoin, people love, millions of people own it. You got stable coins, which are very useful and are set to explode, I think, in a positive
basically
way.
the second major use case of digital assets.
Right. And then when I look for the third, what I see is DeFi applications, particularly swaps and lending. Even Uniswap and Aave as prime examples. They work, but most of the assets are just ETH, Bitcoin, and stable coins, or a bunch of junk. And so the question is, can we get higher quality assets on blockchains? And of course, you're seeing a little bit of it with the money market funds from BlackRock and Franklin Templeton and others. My head goes right to the Holy Grail, which is tokenized U.S. equity securities.
Yeah.
Right? Do you think we'll get that? And also, is that one way you're thinking about Talos growing in the future?
100%. For us, Talos has always been a company that operates in digital assets. Crypto is the main use case right now, but we operate in digital assets. And so, yes, there's been over the years many conversations and a bunch of work that we do to make sure that Talos is the company that supports the digitization of capital markets. And again, I stand behind my words. I really do think that ultimately all assets are digital assets. And I'll tell you why. You're asking actually a very tough question, and the question is about equities. And the reason why it's a tough question specifically about equities is because equities is really good.
Yeah.
Equities in capital markets is traded really well. That's the first.
And there's a
asset
lot of
class.
access.
100%.
I mean, you can trade them on Cash App, let alone Robinhood.
Anywhere you want.
Yeah.
The thing is, people don't necessarily consider the front office and the back office of equities. And yes, trading is very efficient in equities, but starting to do settlement, starting to look at clearing, settlement, netting, credit and leverage, then it becomes interesting. It becomes a lot more interesting. Blockchain technology, and that's kind of like, the technology that would underlie tokenization, gives you capabilities like real-time settlement, real-time views. So you can think of a system where your risk is a lot lower. And actually, it's kind of funny. Look, we still don't see this conversation happening with the regulators, but the regulators must understand that given the new technology, you're going to be able to do things that, in terms of protecting the consumer, that we couldn't do before. So if we're talking about leverage, if you're talking about collateral management, right, being able to look at the collateral from any place in the world through the internet and say, that's exactly the collateral, that's what it is, this is the value of it. And by the way, if it moves, I know that second. Again, we never had these kind of capabilities. I can settle a trade from here to China in a minute. Never had this kind of capabilities, right? How many institutions need to touch everything? How many things need to change, right?
So many.
So as a result, I do think that there's a, we almost like did this exercise, I think a couple of years ago, when we looked at every asset class and we said, if it moved on chain, what it would look like. And sometimes it makes tons of sense, and sometimes you're like, it's not necessarily there yet. And so my point here is this. You can't look at technology as the hammer and basically say, it's going to immediately apply to everything. I think there's going to be a couple of places, what we're seeing with stable coins and effectively like the impact that it's having on FX. It makes total sense. People are trading, people are trying to send money to their families across borders. It's really tough. It's hard to do. Stable coins come to the rescue, and it's a nice and very easy and very inexpensive way to do things. And I think that, things will take a little bit of time, but I do think that we're going to see it trickling in effect into other asset classes as a result.
I agree. I think, it is, you're totally right. The life cycle of a trade in equities is much more complicated than just like pushing buy on Fidelity or Robinhood or Cash App or
because nobody's
Goldman
talking
or
about it,
Schwab.
man.
Yeah,
But
it's super tricky though. Also, from what I see, the regulators are very interested in letting people try this, but they are quite smart in saying, look, we're not going to do this for you. We're not going to tell you how to do it. That's your job. Well, you come to us and tell us how you want to do it, and we'll figure out, whether you need to comply or how to comply or blah, 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 blah. And that's what I think forward progressive thinking, innovation conscious regulator would do, and we have that at the SEC. To me, I just look at it like a friend of mine, Omid Malay-Khan, a professor at Columbia Business School, has been on the show, and he raised a really interesting thing. When we first met back in 2018, and early on in my venture life, we spent a lot of time looking at tokenized stuff, tokenization. Back then, you remember there was this idea that tokenization would be useful because it would bring liquidity to otherwise illiquid assets. for example, real estate. And there were all these real estate tokenization things, and right, they tokenized part of the Aspen St. Regis Hotel, and there was like Real Blocks and Harbor and Templum, and all these went securitized. Some are still around, right? Obviously. And then it was like, well, wait a second, like nobody wanted those. That didn't work. For whatever reason, it didn't. It would have brought liquidity, but then over the years, one asset class had a massive breakout, which was tokenized dollars, which are stablecoins. It's actually the most liquid asset in the world, the US dollar. So then it's like, well, wait a sec, what's the next most liquid? Like if we just use Occam's razor here and say, maybe we were wrong, maybe it'll bring more access to already liquid things, not bring access to illiquid things or liquidity to illiquid things. So the next maybe is what? Sovereign debt maybe is up there, US Treasuries, right? Bam, you've already got some money market funds that are starting out there. Those are basically tokenized treasuries, and then you tokenize that, and there's some movement there. And to me, this is why I look at equities, one, because they're really fun, and like I can't imagine how exciting like an NVIDIA USDC trading pair on Uniswap might be, and how liquid that would be, or like even better, like SPY. Straight up an SPX index fund, just in DeFi, would be widely used, like widely. But it's also like U.S. equities are probably like the third most liquid asset class, right? And so to me, I'm just sort of looking at it, but it's very complicated, as you know. Treasury markets less regulated than equities. FX not really regulated at all. Can't really regulate it. It's like a commodity in that sense. Equities heavily regulated, lots of questions. But that's why I look at it, because I think one, it'd be amazing for I think both traditional markets and for crypto markets to get some join there, but it's tricky.
So I think you're right, and I think that's the crux of it is that people. It's almost like startups when you're starting a company and you have this great idea and it's a technology first idea, right? And you're kind of like building this thing, and then it's a little bit of solution in search of a problem,
right?
And I think that's exactly like whenever we say like, oh, this would be a really good use case or this would be a really good use case, we think about like what the capabilities are and what it can enable. But actually what will govern that is exactly what you're saying, which is traction. And I think that from an asset class perspective or whatever is tokenized next, it's always going to be in the consumers of that. If we have a major asset manager that's coming in and saying, I want to trade this asset and I want to trade it like this, that's when we're going to see that take off. In terms of proof of concepts, in terms of technology that enables it, generally I've seen it all at this point. We have things that are tokenized in fixed income. There's definitely things tokenized in the derivatives in the futures world. 100% seen it in the treasury side. Definitely seen it, even tokenization on the equity side. Ultimately, it's going to be in the hands of the market to go and use this kind of stuff. Even when we have conversations with primary issuers, where people are saying like, debt is a great example, right? You're issuing this vehicle. You can issue all you want and you can hold it yourself. But until somebody decides that they need it and they want to trade it and they have utility for it, it's not going to pick up. So I think now we've kind of gotten to the minimum bar of like, we know generally how to build this. Just like a startup, you now need to find your audience. You need to go and you need to put it in the hands of users. You need to see that the users are accepting it. They see the benefit. They're trading it. And, and one of the things that we're seeing, so stablecoins, 100% agree with you. It's what we're seeing right now. And at Talos, we're doing quite a lot of different things. Part of the reason why at Talos we have crypto and FX is because we have synthetic pairs that we built. We have clients in all kinds of jurisdictions that want to do on-ramp, off-ramp into stablecoins. We have clients that want to provide their clients with capabilities in their native currencies. All of that stuff is connectivity between the FX market and crypto, and that's what we launched like at this point 2.5 years ago, right? We see more of that happening. Like right now, we're seeing a lot more clients starting to ask about yield. Well, like, hey, I want to hold something that, if I'm holding an asset and I'm holding an asset that is generally safe, if I'm holding it in capital markets, generally I make some yield on this. And then, so we're actually seeing some of that stuff is happening now on chain. Things are coming in as you've seen the stable coins and now you're seeing the evolution of that, which is going towards yield and producing yield to the customers. I also think it's like a very timely conversation. We'll see what the next couple of weeks go, but I think we're going to see some activity from a regulatory perspective on what staking means, right? And so quite a lot of interesting things there. My entire point is like, you're going to follow the demand. Like that's where the market is going to go. Unless you have clients that are touching this kind of stuff, nothing matters. You can have the best, beautiful looking technology.
That's a good point. And it does make me think about your point when I think it's a good counter or even corollary, maybe a full counter to my idea about the tokenized equity securities, because the prior point we're making is trading equities is great for almost everyone that wants to. There's so many more, never been more ways to do it. So like how many people are now, a counter to that is that there really just is a fairly large amount of on-chain wealth and even just that, it's large in an absolute sense. It's, a tiny portion of global wealth and global trading activity, but maybe just to service them. It's kind of how I think about like BUIDL, BlackRock's BUIDL. Do they need like 30 plus new clients for a money market fund? I mean, they can get those. They don't need it. But there was demand from these treasuries on chain saying we actually need treasury, these lowercase t treasuries on chain, like projects, foundations and stuff. They needed exposure to the risk-free rate, basically. And so then there was demand and it got sucked on. And I wonder, is there enough demand on chain to actually force equities on? Or will we? It sounds like, honestly, it sounds like right now there probably isn't.
There might not be enough demand right now for tokenized equities, but the cool thing about on-chain is that, again, like the technology underneath it allows you to innovate pretty quickly. And that's kind of like like a lot of people ask us a lot about centralized markets versus decentralized markets. And what do you think is going to be the balance and what's going to happen? Are we going to see more activity here? Like that's a common thing that we hear from our investors who are, participants in the market, right? The cool thing about decentralized markets, and that's going to be true for those kind of assets, is that you can innovate very, very, very quickly. If you want to create a tokenized security, then you want to create some sort of derivative on it or trade that with respect to another one, and you want immediate settlement, and you don't want actually like interacting with too many people in the equation. You want to do that right off the bat, and you want to do it 24/7. Guess where you can do it? Yeah. So it's a very common thing. It's like thinking about the web. Internet was created, right? And people were initially thinking about all the older companies and how they migrate to the web. But actually, web created a bunch of newer use cases, newer companies because of the innovation. And I think that that's what's going to happen on chain. We're not going to see exactly the same market on the security side. We're actually going to see an evolution of it, and that's going to attract quite a lot of people because of the capabilities, because potentially even alpha or any kind of edge that you can provide there. Better margins, bigger vehicles, right? I still think it's going to take a reasonable amount of time. Yeah. And to your point, the interesting thing is how much regulation actually goes into securities. And that's going to be like a little bit of a roadblock. That's the roadblocks that FX does not have.
I know. You can't really, FX trades across borders. It's like government notes. You can't like, it's honestly a little bit like gold. It's the reason why the CFTC doesn't regulate spot commodities. They can't. Gold, right. What's the primary trading market for gold? I don't know, like, sure, you got like NYMEX but you also got like, a pawn shop in India, right? Like, I mean, it's like oil is controlled by a literal cartel, right? You can't regulate that. I mean, you could try, but it's not going to work, right? And FX, I learned this once, I mean, from a trader friend of mine, but that, you can't, FX is sort of, you're meeting in international waters when you swap USD for GBP or something, right? It's like,
I mean, effectively.
Yeah. And so, and I actually wonder about this with Bitcoin and whichever are determined to certainly be commodities. Similar question, like how do you regulate the spot trading of Bitcoin? It's kind of like regulating a dude who pulls up his pickup truck and sells corn out the back of his pickup truck. You can't regulate that. You can certainly say if you are a U.S. operating spot crypto venue, you have these rules. But like, there's going to be foreign venues always. It's an intangible asset, and it's global. So I wonder that question. I love your point about the speed and evolution about DeFi too. I was going to ask you about this because, and just to be clear, like Talos' connectivity and tools. If I'm an institution, can I access on-chain liquidity and things like that?
Yeah.
You see more demand for that?
Absolutely, but we see demand for that because of certain use cases. So we integrated with DeFi, I think roughly about slightly more than a year ago at this point. We also had one acquisition in the space. We acquired a company called Skolan, which is great technology we've seen, which is parallel to what we did in centralized markets. They've done in DeFi, and so now that's embedded into Talos technology. And generally, we see two different use cases in DeFi. One is portfolio management. So people come to us for, hey, I'm holding assets on chain. I need to track those assets. I need to understand the risk behind those assets. Maybe I need to move those assets. How do we do this? Through portfolio management. So our portfolio management system, it's the system that basically needs to be very, very wide in terms of its capabilities. Have to see what's happening in decentralized markets, has to be connected to DeFi. The execution side, obviously the sexier of the two,
Trading.
kind of.
Yeah.
So we don't do anything sexy, generally speaking, but like it's for us, it's sexy.
Yeah.
The execution side, we connect to the DeFi markets, and we're expanding that connectivity now constantly, because we're seeing very different type of demand. People don't come necessarily to decentralized assets, to decentralized markets to trade because they're seeking for a lot of liquidity that already exists in centralized markets.
Right.
Actually, we have a bunch of clients that are coming in, and maybe their thesis is like, hey, I want to get exposure to the asset before it lists. And we don't know when it's going to be listing. And by the way, it's super thinly traded. And I'm going to be there every single day. I'm trying to get into a position of, let's say, $50 million, right? But it's trading about 2 a day, right? How do you do this? Institutional tools. They plug in our algo. Our algo works every single day for them, taking a little bit pieces in the decentralized markets and gets them into the target position. So that's kind of like the first one. And then now, literally now, we're starting to see first glimpses of derivatives market that's starting to show the liquidity capabilities that we're seeing in some of the exchanges. And we're seeing some additional liquidity in instruments like Ethereum that could potentially rival some of the prices on centralized markets. So connecting to liquidity in general is good, but it is still early a little bit on the decentralized markets.
It is a big change. I feel like we saw over the last year even that like new project, it used to be all about the centralized exchange listing for any crypto asset. But with how robust the on-chain environment has become, particularly also aided by like meme coins as like the fluid that was pushed through the pipes so extensively that it, hardened them and created a lot of innovation. Projects launch on-chain now. Like tokens list well before. In fact, you saw the exchanges like when certain large meme coins were released that had a lot of sort of like global and retail appeal. They had to race the centralized exchanges to add them because they were trading right away, and that's where they launched in DeFi.
That's right.
I wonder if that's going to be the case now for pretty much every new like crypto asset, not necessarily every digital asset, but every crypto asset. That used to be the main thing. Remember, you'd have the feed, you'd have like an RSS feed or an alert set up from some provider. And Masari used to provide these alerts, like the block, you pay for premium the block to know like, oh my gosh, like Binance lists like XYZ coin, like then there would always be a pop, and like that was because finally people, normal people could buy it. But now you've got a lot of people on chain. Maybe this is the positive lasting effect from the meme coins as well.
I think it is.
It at least got a lot of people to open like Phantom and MetaMask wallets.
Yeah, absolutely. And I think it's so generally what we see right now is, when our clients are starting to get into, like, again, like while we provide services to our retail brokers and they face the retail, we obviously don't face the retail, right? So when we see this activity, we kind of see it one step removed. But a lot of times right now, if there's an exciting launch on DeFi, it's basically that's the first phone call we get. We get like, hey, I want to trade that asset. How do we do this? Is it already listed on the platform? For us, it's super easy. We support every asset that we connect to, so clients can start trading right away. Immediately afterwards, there's more institutional guys are coming in and they're saying who from the OTCs support it, and we're seeing a race from the OTCs to start immediately pricing that asset. We've seen that with a couple of recently launched tokens in the United States. They've gotten quite a lot of fanfare. And only then, after a while, it reaches the exchanges on the centralized side, and again, opens up the door to yet more investors there. So it's really fascinating to see. And I think that part of it, to your point, right? People used to wait for the exchanges to list things, but the user experience improved on the decentralized side. For people to like, do you remember how hard it was to trade on DEXs? Like, it used to be so difficult. That's actually just not the case today. Like, sure, it's not institution, but as a retail client, I can come into decentralized exchange and I can trade assets pretty quickly, and I can trust it. I can see my assets. I can understand the entire flow, and that's a huge difference from like 5-6 years ago.
What else is a huge difference in your mind if we step back from 5 or 6 years ago? Because you do have the president. He signed an order a couple weeks ago saying the order was titled, the executive order, Establishing a Strategic Bitcoin Reserve and a United States Digital Asset Stockpile. That came, obviously, about a month and a half after the first crypto executive order, which established the Presidential Working Group and empowered David Sachs and his team and to basically review, catalog, suggest changes, and ultimately overhaul all of the U.S. government's approach to digital assets. That's obviously a 180-degree turn from the last administration. But again, you've been working in this a lot longer than even that. I mean, you were launched during the last Trump administration. I mean, it's been a wild ride.
Oh my God,
that's
true.
Yeah, give us some perspective, Anton, on like how far we've come and where we're going.
Yeah, it's of course, it's honestly it's crazy to think. Like the kind of changes that you've seen in crypto over the past, call it like 6 years, 5 years, is the changes that other asset classes that we've been involved with that happened before my time in those asset classes, like over decades and decades, like electronification and going into look at the liquidity destinations, right? Like you were talking about Trollbox. Trollbox is an interesting one because I remember that one, right? Like it was on Polo, you would get in there and it was like the first time you could do something like that and people were like,
yeah, it was like
is this
social trading.
Yeah.
Before, now you have that a little bit in traditional markets. There's capabilities like that, but that was revolutionary.
It was pretty new.
You could literally buy something, and then people would buy something, and then come into the troll box and shill it right away.
On the other hand, institutions basically had no way of interacting.
Right.
If you were connecting on APIs, there were no institutional access. So hey, if the connectivity went down for an hour, tough.
Yeah.
If something happened to your trade and you sent a trade and you don't know if you matched or not, and it wasn't reported to you, you had nobody to call.
No.
Right? Like when we came into the sector, we said we're going to provide the institutional layer for this. And today, back in the day, it was clients would come to us and they say, we're just looking for connectivity because we provided right away. We provided Fix, we provided WebSocket, all the different tools. We said one API, you connect to everybody. That's still the case today. But at the time, it was just a race to build as much connectivity and standardize this as much as possible and then protect your clients from it. The evolution from then to today, cross-connects, co-location, like the kind of stuff that we're used to in capital markets. Still not 100% there, but that's the course that Kraken announced that I think yesterday.
Yeah.
It's an institutional level of matching facilities, destinations. You can have, specific use cases, specific order types that were not existing back in the day. But even the entire environment is it was funny to have a conversation with an institution. We tried and tried and tried to talk about crypto and what's your approach to crypto. And I think the only reason we weren't immediately left out of the room is because they knew us from capital markets. And they basically said, we'll give you a little bit of time to talk about this stuff. But otherwise, it was impossible to have these kind of conversations. Only the hedge funds that are very, risk friendly and experimental were able to get in quickly and try to see what's going on. But it was relegated to those kind of players. And that's to your point today. It's in the media. It's discussed at the White House level. There are executive orders related to that. The one thing I say is, my hope, going through different administrations. My hope is always that we're going to see bipartisan support. My biggest concern is that at some point it's going to flip and then one side is going to like it, one side is not going to like it. But that's not the right attitude towards the technology. That's not how things should progress. And my hope is that we're going to see a sane, measured approach to digital assets and crypto adoption. And we're going to see this across the board. But I'm very, very happy to see that at least, some of the wrongs of the past 4 years, which has been not easy 4 years, especially the last 3 years, I would say, has been largely, at least we're seeing that starting to reverse.
Well, I agree, and I also hope that. So, Anton Katz, CEO and co-founder of Talos, thank you so much for coming on Galaxy Brains.
Thank you very, very much for having me, and keep doing the great job that you're doing.
I'll do my best. That's it for this week's episode of Galaxy Brains. Thank you to our guest, Anton Katz, co-founder and CEO of Talos, and our friend, Connor Finemore from Galaxy Trading. BIMNet will be back next week, and until then, everyone have a safe and happy weekend. We will see you next week. Thanks for listening to Galaxy Brains, the weekly podcast from Galaxy Research. If you enjoy the show, please rate, review, and subscribe wherever you get your podcasts. To follow Galaxy Research, sign up for our weekly newsletter at gdr.email, read our content at galaxy.com/research, and follow us on Twitter at GLXY Research. See you next week.